Look at the trading plan. We will look at why you need a trading plan, how a trading plan can help, and what should it cover. There are a lot of people out there who want to become traders. There are a lot of people out there who try to become traders. For the most part, retail traders approach the markets without any sort of definite plan. Is it any wonder 90% of them fail? If you want to succeed in such a difficult industry, you need to separate yourself from the majority of traders out there. One of the ways to do that is by having a plan. Trading is extremely difficult. If you do not have a detailed plan to help you, you are making it even more difficult for yourself. Believe it or not, your emotions will also play havoc with your decision making. Without a plan, you are prone to making emotional decisions rather than decisions that make sense for your trade. Think about it like this. Do you think any professional trader trades without a trading plan? Then why would you? You don't start any business without some sort of a plan, and trading is no different. If you want to succeed, then give yourself the best possible chance of doing so. So, how can a trading plan help? Trading involves uncertainty. Add to that the fact that you are risking your money on trades, and it becomes a stressful endeavour. What tends to happen when people make decisions when stressed or under pressure? They make mistakes. Now think about being under pressure, making a mistake, and that mistake costs you money. What does that do? It adds to the pressure, and your mistakes can easily snowball. Your trading plan can help. If you know exactly what you should be doing each step of the way, you can reference your trading plan before making a decision and follow your instructions. On top of that, your trading plan is your map through the markets. If you do not have a plan and just make random decisions, how do you know if your decisions will leave you profitable over time? If you have a well-tested and structured trading plan, you know you are following something that has shown to be profitable in the past and so has a good chance of being profitable in the future. Every trader needs to have an edge in the markets. Their edge is what allows them to extract profit over time. Your trading plan basically defines that edge and how you execute it. What should your trading plan include? The simple answer, as much as possible. The more detailed your trading plan, the less left to guess when you are trading. Being detailed also means that you can backtest and forward test it effectively, because you know exactly what you are looking for and how you are executing the trade every time. If you do not have a plan for what you should do in each situation, you are instead relying on your decision making under fire. Long term, that is a recipe for disaster. So your plan should include things like your risk per trade. It should cover the markets and timeframes you will trade. Your entry parameters should be clearly defined. For example, the market must be at a support and resistance level. You need to see a pin bar, signal candle, etc. How will you enter the trade? Straight after the signal candle? Do you need the market to break the high or low of the signal? What about a close through a moving average? What exactly do you require to enter the trade? How will you calculate your stop size? A structure stop? Small stop? What size exactly? Does your stop ever come to break even to protect the trade? Maybe after you reach a certain amount of profit. When do you exit the trade? At 1 to 2 risk reward? When you reach another support and resistance level? When do you stop trading? After what size drawdown do you step away from the charts and take a break? It should be as detailed as possible. You can include whatever you want in the trading plan. It is designed to define your edge in the market and allow you to execute that edge effectively. Let's have a look at putting together a very simple trading plan. It is not one we suggest you use. We need to decide on a time frame. The main consideration here is, does it suit you and how you want to trade? For example, you might have a great trading plan for the 1 minute time frame that requires you to be at the charts all day, but you work full time. Obviously, that wouldn't work. We will settle on the 1 hour time frame. That way, you can set alerts at your important levels. Lots of people also only look in the mornings and at evenings. However, for identifying your support and resistance zones, you decide to use the daily time frame and only pick out key levels. Now, what market do you want to trade? Let's keep it simple and say you want to trade Forex. You settle on major pairs because you want a low spread. What about risk per trade? When you are starting out, keep risk as low as possible. 0.2% per trade, 0.5% per trade, 1% per trade. Remember, you want to approach this like a professional, not a gambler who has wild swings of profit and loss, but ultimately always ends up with an account at zero. We will settle on risking 0.5% per trade. What about trade signals? Again, we are keeping this relatively simple. First, the market must be testing support or resistance that you have identified. Second, you need to see a pin bar entry candle. And third, the market then moves above the high or below the low of the pin bar, depending on if you are looking to buy or sell the market. Our target for each trade is going to be 1 to 2 risk reward. Our stop we decide to have as the length of the signal candle added to the high or low of the pin bar. So if we are selling and the pin bar is 30 points in length, our stop will be 30 points above the high of the candle. What about getting our stop to break even? We will bring our stop to break even once the trade reaches 0.5 to 1 risk reward, meaning our trade is risk free. Okay, now we can start putting it all together. Markets, major Forex pairs. Time frame, initial analysis on the daily, trading on the 1 hour. Risk per trade is 0.5%. Entry, a pin bar at resistance or support level is my signal. Entry is if the market then moves above or below that pin bar, depending on if I am buying or selling. Target, 1 to 2 risk reward. Stop is the length of signal candle added to high or low of the signal candle. Stop to break even once the trade reaches 0.5 to 1 risk reward. What now? Start trading and counting all the money you make? Not quite. Now you test your plan. Remember, you have no idea if you even have an edge. It may fall apart when you try and trade. What you would do first is set everything up on your charts using the historic price data. You then run through every trade signal that would trigger and mark up exactly how each trade would work out. This is called backtesting. You can also forward test, which would involve using covered sections of the screen to the right to imitate live trading. This is when you find out if the system actually works, and also what changes are required. If you see that you will suffer too many losses, you need to consider what changes you need to make. Perhaps the stop is inefficient. Do you need to run profits to a greater risk-reward level? Are your support and resistance levels not working very well and you need more practice plotting them? This testing can take a long time, but is very important. Remember, the trading plan is your instruction manual. Some people use automated systems to backtest. I do not like these because often people curve fit the system so it works in backtesting but will never work when trading live. For example, you may see that you have 3 trades that lost on a Thursday at 11 AM. So you decide to not trade on Thursdays at 11 AM. This makes your backtesting look better, however it would not work trading the system. You are simply using any adjustment you can find to improve and make the system work on the data. It also doesn't allow you to learn the system as well as manual backtesting. This is important because when you are testing, you can grow a good understanding of the natural ebbs and flows of your trading plan. The automated system may tell you that the worst drawdown was, say, 20%. However, when it comes to trading, after the losses start piling up, it is easy to lose faith in the system and/or start making mistakes, or even abandon it completely. When manually backtesting, you are marking out each trade and witnessing it. It is more like trading and helps you learn the system and how it works. If you repeatedly see 3 trades losing in a row when backtesting, then if it happens live trading, you are already expecting it and your mind is prepared for it. Now that we are talking about drawdowns, I wonder if any of you notice that we miss something off of our trading plan. Let's add it in. My system very rarely has 3 losses in a row. So if I have 3 losses in a row, I will take a day off. If I then have another loss when I come back to the charts, I will take a full week off. This will also help me with emotional trading. If I know I am already in a poor trading week, I do not want to compound it with mistakes. After that, is it time to trade? Well, not quite. You now have your plan, but you need to know your plan inside out. Demo trade for a while. Make sure you know what to do in any circumstance. Find any weaknesses that you didn't notice when testing and iron them out here. Look for consistency before considering going live. Then you can go live, but risk very small and don't put too much pressure on yourself. Mistakes will happen. Let yourself have the time to learn. All finished? Time to ride off into the sunset with your bags of trading money? Not quite. Your trading plan will continue to evolve as you trade. You will learn new methods and spot new ways to execute an edge as you gain experience. You will also realize that some things just don't work for you. Perhaps you want to trade frequently and so have your trading plan set to scalp trades at 0.7 to 1 risk reward. And then after a few months and losing a lot of hair through stress, you decide that it just isn't for you and it would work better if you could set and leave trades looking for 1 to 3 risk reward. I have updated Zone Trader many times. It continues to evolve alongside the ever-changing markets. That includes 2 enormous redesigns, stripping it back and building it back up again to suit ways I found to better trade the markets. I always expect to see personality added to a trading plan by students who are going to succeed. The Zone Trader students who I then see going on to consistency always focus on the plan and learn it inside out, but then start to add in their own little pieces. Perhaps an extra indicator or a slightly different entry method. Maybe they prefer trading it on the 30-minute time frame rather than the 5-minute time frame like I do. That is a sign of not only growth but confidence in their abilities and is all part of becoming a trader.
Yeah.